Imagine this. You're walking down the street feeling fantastic. It's Friday. The sun is shining. You're holding a life-affirmingly perfect cup of coffee. Then, disaster. You trip over an uneven bit of sidewalk. The coffee goes flying in slow motion. It splashes on a pristine white shirt of a passing stranger. The stranger reacts, clearly not thrilled. They say it's a custom $1,000 shirt. Suddenly, your perfect Friday has a $1,000-sized hole in it. This is where the practical math of insurance comes in. Think of it as a giant collective safety net. Lots of people pay a small amount, a premium, into a big pot. We pay this money to an insurance company. In return, the company promises, if something bad and specific happens, they'll dip into that pot to cover costs, like the coffee spill or a car accident. It's a trade. Small regular payments to avoid a huge one-off loss. Insurance is built on the concept of risk, the chance something bad might happen. We face risks daily: getting sick, house catching fire, backing a car into a mailbox. So we buy health insurance, home insurance, auto insurance. We're transferring potential financial burden from our shoulders to the insurers, turning catastrophic costs into predictable ones. But you can't insure everything. You can't insure your favorite show's cancellation or a bad hair day. So what's the secret recipe? What transforms an everyday worry into an insurable risk? Insurance companies aren't just gambling. They're meticulous mathematicians of misfortune. They have a strict set of rules. Rule 1, the loss must be due to chance. It has to be accidental. It must be unforeseen. You can get insurance for your car being stolen, but you can't insure intentionally driving it off a cliff. That's fraud. The element of pure dumb luck, bad luck, is essential. Rule 2. The potential loss must be definite and measurable. You have to be able to put a price tag on it. If your house burns down, an appraiser can determine its value and the cost to rebuild it. This is why you can't insure a broken heart. Is it a $500 heartbreak or a $50,000 one? There's no objective way to calculate that. Rule 3. The risk has to be predictable on a large scale. An insurer can't know if your house will catch fire next year. But by looking at massive amounts of data, they can predict how many houses in a city of 1 million will catch fire. This is the law of large numbers. They calculate probabilities and figure out how much to charge in premiums so the pot covers predicted losses. Rule 4. The loss cannot be catastrophic for the insurer. Catastrophic means it hits a huge number of policyholders at once. A single company might handle a hurricane hitting a small town, but they can't handle risks that affect everyone everywhere, like a global economic collapse or a major war. If a loss could bankrupt the company, they simply can't insure it. The risk has to be spread out so one event doesn't wipe out the entire pot of money. The most common type of uninsurable risk is a speculative risk, which is one you take on willingly in the hopes of making a profit. Another classic example is one that is guaranteed to happen. You can't buy insurance to cover your car's tires wearing out. That's not a risk, it's a certainty. Finally, you have risks that are against public policy to insure. Insuring against fines or illegal activities would remove the deterrent effect. Understanding insurable risk is incredibly empowering. When you know why insurance exists and what it's designed to cover, you move from passive consumer to informed decision maker. You can identify potential financial disasters and take logical steps to protect yourself, focusing on coverage that provides real security against significant accidental losses. In the end, insurance is about peace of mind. Understanding insurable risk is the key that unlocks that peace of mind, allowing you to face the unpredictable chaos with confidence. And that, like a perfect cup of coffee on a Friday, is a wonderful thing.